Everyone loves receiving dividends. There's something comforting about getting paid just for holding a stock. It acts as some sort of cushion or reassurance regardless of how the market is performing at the time. And if you're investing in UK companies, there's plenty of high dividend stocks to choose from, especially in defensive sectors like energy and consumer staples. However, people often make mistakes when it comes to dividend investing. They chase the wrong things and end up with a bit of a dividend disaster. So in this video, I'll go through the terminology needed to research dividend stocks, the common pitfalls to avoid, and how to screen to increase your chances of success. By the end of this video, you should be a more confident dividend investor. This video is sponsored by Stockopedia, the UK-based stock analysis and research tool helping you make more informed investment decisions. Remember, this video is not investment advice, it is for informational and educational purposes only. Individual stocks are, of course, riskier than investing in funds, and you should always do your own research and consider consulting with a financial advisor before making any investment decision. When investing, your capital is at risk. Before talking about researching individual stocks, though, it is worth looking at funds to get a general idea of how the UK stacks up for dividends and why UK dividend stocks may be appealing at times of uncertainty. I usually refer to the dividend yield of a FTSE 100 ETF compared to an S&P 500 ETF to show just how much better, on average, UK stocks can be for dividend income, with yields currently at 3.5% compared to just 1.14% for the S&P 500. Now, of course, total return is a completely different story, and the FTSE 100 has lagged the S&P 500 significantly in recent history. But in 2025, with rising geopolitical tension, Trump's tariffs, and US valuations remaining stubbornly high, UK dividend stocks may be looking more interesting than usual. Looking at my ETF cheat sheet on the leaderboard tab, the iShares UK Dividend ETF is actually at the top year to date. And this is a share price return, not including dividends. So it does seem to be a year so far where UK high dividend, defensive and value-oriented shares are doing well. If you'd like access to my ETF cheat sheet, you can get free access via the link in the description. This is just one part of it. I would stress though that looking at year-to-date performance is never a good indication alone, as we can't go around chasing whatever the current winner is. FOMO investing is rarely a good thing. I personally prefer to keep the core of my portfolio globally diversified, and UK dividend stocks would be a fun or satellite position for me. But what is suitable for me may not be suitable for you, and I can fully understand the appeal of dividend stocks for some. Looking back, 2022 is another good example of a situation where UK stocks have done well, whilst US markets stumbled. The FTSE 100, with its heavy weight in defensive dividend payers, significantly outperformed the S&P 500 that year. Whether 2025 is a good time to invest in UK stocks or not, and where this year will end up, is something I cannot answer. But let's be honest, a lot of UK investors naturally gravitate towards UK stocks. It's called home bias. If you've ever seen investment platforms offer portfolios with a UK tilt, this is why. They want to appeal to a UK investor's home bias, and whilst it's not always a good thing, when it comes to dividends, there is one clear advantage. Many UK stocks will have no withholding tax on dividends. You receive the full declared dividend as a UK investor. This is unlike US stocks where you're hit with 15% off the top, even with a completed W8 Ben form. I say many UK stocks and not all because some stocks may be listed on the LSE but headquartered in a different country, so withholding tax may apply. B&M is one such example that comes to mind. I recently received a dividend and had 15% knocked off as they are headquartered in Luxembourg. Okay, now let's get into how to find the best UK dividend stocks, and to do that, we need to understand some key terminology. Here are a few key terms to understand specifically in the context of dividend stocks. First up, unsurprisingly, dividend yield. This is what many obsess over when they first get into dividend investing, as it is a measure of how much income an investor has received or may receive. It is calculated by dividing the annual dividend per share by the share price. The dividend per share can be either trailing, so based off dividend per share over previous 12 months, or it can be forecast, based off expected dividend per share. It is important to distinguish between the two, and a trailing yield may be completely different to a forecast yield, as companies may cut or increase their dividend. It's also worth remembering that a yield is not a static figure. It is constantly changing because the share price also constantly changes when the markets are open. A sudden, sharp drop in a share price can lead to a dividend yield being high and looking tempting. More on this later. Next up, we have dividend cover. This shows how comfortably a company can pay its dividend from its earnings. Dividend cover is calculated by dividing earnings per share by dividend per share. Depending on the figures used, this can either be forecast or trailing. A dividend cover just above or even below 1 might be a red flag, as a company is paying out more than it earns. A low dividend cover may not always be a bad thing though. If a company has a lot of cash on the balance sheet and has low running costs, they can afford to pay out a lot of dividends without a problem. Games Workshop is one example, where they have a policy of paying out truly surplus cash to shareholders. Without this context, the dividend cover may look concerning, when in reality they're a very healthy company and they're not paying out more than they can afford. Moving on, dividend per share growth. This refers to how much a company increases its dividend payout per share year over year. You calculate DPS growth by taking the current year's dividend per share, subtracting last year's dividend per share, dividing that number by last year's dividend per share, and then multiplying by 100 to express it as a percentage. The formula looks like this. Ideally, you want to see consistent DPS growth over several years, as this indicates that the company prioritizes rewarding shareholders and is confident about future profitability. Consistent DPS growth is particularly appealing if your goal is stable and steadily increasing income. DPS needs to increase in order to have a chance for income to keep up with inflation. However, linking back to our previous term, dividend cover, it is crucial to check whether company profits and earnings per share are growing at a similar pace to support these increasing dividends. If a company continues raising dividends whilst profits remain flat or even in decline, the dividend cover will deteriorate. Over time, this may become unsustainable, raising the risk of future dividend cuts. Not to mention, if earnings are increasing, I can't imagine the share price is going to be too great either. Always ensure dividend growth is backed by solid fundamentals and sustainable earnings growth. Now, this is dividend-specific terminology. We need to remember that all other parts of stock picking apply, and you need to know an abundance of other terms. But we'd be here all day if I was going through all terminology to do with investing. More on some of them later, but we're focusing on dividend investing terminology given the topic of this video. Before we go any further, I'd like to thank Stockopedia for sponsoring today's video. When it comes to researching stocks, I rely heavily on Stockopedia. All of those terms I just went through can be found for each stock with ease on Stockopedia via their stock reports. They break down all of this data and much more. For example, I can see the 12-month forecast rolling dividend yield at the top here, along with many other valuation metrics. Down in the dividend section, you can see the dividend per share and how it has changed over the years, dividend growth, historical yields, and dividend cover. This is of course alongside all the other data on the financial summary. There's a specific dividend page with all the historical and upcoming dividend payments, as well as a handy chart to visualize the change over time. A unique feature of Stockopedia is the stock ranks, which apply factor investing to give every stock a rank out of 100, quality, value, and momentum, alongside an overall stock rank. I've done videos on factor investing specifically before, but to summarize, quality is a measure of how profitable and healthy a company is. Quality businesses are typically high margin, cash generative, and have strong balance sheets. Value is a measure of how cheap the stock is relative to their earnings or assets. Momentum is all about whether the stock is currently winning. Has the share price risen or fallen recently? And what is the trend of earnings estimates? Are they being upgraded? These are super useful for an at-a-glance insight, as well as for screening between stocks, dividend or not. Stockopedia have found, especially for the UK market, that on average, high-ranking stocks have significantly outperformed low-ranking stocks, so it has increased chances of finding winners. Of course, it should always be remembered that there are no guarantees, of course, and stock rank should be just one part of the overall research that Stockopedia makes much easier. If you want to try Stockopedia out, you can claim a 25% discount with the code TP25 at checkout, or just use the link in the description. Thank you to Stockopedia for sponsoring today's video. With terminology out of the way, I thought it'd be best to go over the most common error that people make when researching and picking dividend stocks, and that is focusing too much on dividend yield. Some of the highest yielding stocks can be outright value traps. If a share price crashes because earnings are falling or the company's in trouble, the dividend yield can look high. But that's often a warning sign, not a bargain. They might score highly on valuation metrics temporarily as trailing metrics give a false indication, or they could have very little or no expected growth. So valuation metrics can look very favorable despite it being a stock that may well remain cheap for a long time or forever. To help avoid this, I always check the following. Quality criteria. Is this a profitable, growing company, and how does the balance sheet look? Momentum. Is the market showing any confidence in the stock? Yield may be super high, but the stock is down 50% over the past year. Well, probably not a good sign. And also, is this stock beating expectations? Dividend history. A long track record of stable or rising dividends isn't a guarantee, but it is a good sign. Total return. Now, I know I can annoy some people by focusing too much on total return, as for those who solely want an income, total return may not be as important. That being said, remember, total return is what builds wealth. And when looking at yield, some stocks with only a 2 to 3% yield might deliver a better overall return if they're reinvesting into the company, expanding, and have a good potential for share price growth too. A healthy, growing company is also much more likely to maintain and grow its dividend at an above inflation rate. To sum up, if a yield sounds too good to be true, it probably is. And especially if it is a trailing dividend yield, it is no indication of what the company will pay out going forward, especially if they run into trouble. With this trap in mind, here's how I would screen for dividend stocks to filter out junk and increase my chances of picking winners. No screen is a guarantee, of course, and it is not an excuse to not do further research, but it is a good start. I'm going to use Stockopedia, the sponsor of today's video, because of how easy it is to do automatically, but you can screen yourself manually. It would just be much more time consuming and difficult. Here's the filters I've applied. Quality rank over 70. This ensures junk, low quality stocks are excluded. Dividend yield between 2% and 6%. This is the sort of range of yield I personally find most attractive. Any less than 2%, and I think it's hard to call it a dividend stock, and any more than 6%, and it's usually not the sort of company that matches my style of balancing dividend income and potential for share price appreciation. That's a generalization though, and not a hard and fast rule. There may be some high yield stocks that have good potential. Dividend per share compound annual growth rate using 5 years of data greater than 5%. This is to make sure I'm only finding companies with a track record of dividend growth, often a good sign. And finally, market cap over £300 million. This is to filter out micro caps, as I personally am not interested in that section of the market. Companies of this size are usually higher risk, and the liquidity and spread can be horrendous. Put together, this gives me a short list of higher quality dividend stocks that have decent but not excessive yields, have grown their dividend per share, and also filters out riskier, illiquid sections of the market. From here, I'd see these stocks as candidates for further research. Look into what the companies do, check out recent reports, check the balance sheet and financial summaries, analyst estimates, the list goes on. To conclude, dividend investing in the UK doesn't have to mean just chasing the highest yields. With the right tools and filters, you can build a portfolio of high-quality dividend stocks that offer not just income, but also avoids traps and allow room for potential growth. I personally have the vast majority of my portfolio in funds, but when I do go into individual stocks, whilst I fully acknowledge I'm not an expert, this is what I do to increase my chances of avoiding dividend disaster. Research is important, but diversification is more important. I see a lot of overconfident people putting all or nearly all their portfolio into one stock. That is incredibly high risk, no matter how much research you do. If you do build a portfolio of individual stocks, do not forget to think about diversification. And if you enjoyed this video, don't forget to like, subscribe, and drop a comment below. What's your favorite UK dividend stock right now? As always, thank you for watching.